In this second of three parts of the Defining Options course, we cover the basic terms that are useful to know when speaking about options. Let's clear up a few terms before we get much further into the syllabus. Options, as a fundamental concept, are quite straightforward when it comes to stocks. However, there are so many concepts that seep into options trading from other sources, including non-stock option types and trades, and just everyday financial behaviors, that things can quickly get muddled. The market is a large place with a rich history, lots of nuances, and a whole lot of mathematical and psychological models that influence the semantics of options. The following terms are fairly intuitive to pick up, and I've already used some of them a few times in the introduction. I define the more relevant ones here so that we're on the same page and so that you have a slightly more formal sense of how these terms are supposed to be used. This will help you going forward with the rest of the syllabus. Holders and writers. It can get a bit confusing with derivative financial vehicles like options when it comes to discussing when shares or options are being exchanged, so we use the term holder and writer to replace buyer and seller, respectively. The problem is that one can buy or sell options, which in turn either offers opportunities or obligations to the other party to either buy or sell the underlying shares. There's a lot of overlapping of the terminology that sometimes even context cannot clear up easily. If a person sells an option, they are often called the writer of the option. An option writer, or simply the writer, is the person obligated to deliver the positions when the buyer of the option chooses to exercise their choice. The writer gets paid up front, but they also have the obligation to fulfill. The buyer of the option is called the holder of the option to indicate they are holding onto the contract and can request the seller to fulfill their part of the contract when it makes profitable sense to do so. The holder of the option can require the writer to fulfill their obligation. This is called exercising the contract. Exercise an assignment. The holder/buyer of an option is the person who exercises their choice on or before the expiration date. An options holder essentially converts their options contract to an equivalent multiple number of shares of the associated underlying when invoking the right to exercise, usually 100 shares per contract. Should the option holder exercise the contract, the writer/seller is then assigned the task of delivery. Once they've fulfilled their part of the contract, the writer is said to have been thusly assigned. This will become more clear when we get into the distinction between a put and a call. Underlyings and deliverables. By now, we've already used these two terms often enough that you should have a good sense of what they mean. For completeness, let's define them. The underlying of a stock is the company stock, fund, or index upon which the option is based. An option contract for Apple is based on the stock of Apple, simple as that. As the price of Apple stock changes, so does the price of the options related to Apple. The price of the options happen to change at different rates and under different conditions than the underlying stock does, however. Deliverables are the shares of stock itself. In a vanilla options contract, 100 shares of stock is delivered to the opposite party when required. There are other types of options not based on stocks, and the deliverable for those may be different. For comparison, options on future contracts rather than stocks may require the delivery of 12.5 or 50 or a fraction of the underlying units, whatever those units might be. Strike price and spot price. Spot price is easy. This is just another way to say the current price of the stock. It is often shortened to simply the spot. Strike price is the agreed upon price for the shares to be bought or sold when exercised. When the spot price and the strike price are the same or nearly the same, an option is considered to be at the money. Liquidity. Coming back to the example of real estate, houses are stable financial vehicles generally speaking. The price of a house does not fluctuate much from day to day, and more importantly, it takes a lot of legal work to unwind the ownership of a house from one person and transfer it to another person. It takes weeks, even months to do so. Such a financial vehicle is categorized as illiquid. It is hard to transfer the thing of value to cash being the most liquid form of assets. Stock options, especially in the modern digital age, are far, far more liquid than homes are, and as such can fluctuate in value from minute to minute. Even within stock options, there are varying degrees of liquidity. Some stocks are simply harder to trade than other stocks, and thus they and their corresponding options are less liquid. A little-known publicly traded company has only a fraction of the stock volume that Apple has, for instance. Apple is far more liquid than an unknown brand, and thus it is far easier to purchase options on Apple than many other companies. Amazon, Apple, Facebook, and Microsoft are some of the most well-known companies in the world, and combined their sheer market capital size makes them the most liquid stocks in the market. Only the likes of exchange-traded funds and index funds, which incorporate hundreds, if not thousands of stocks within them, are more liquid. This ends section 2 of the Defining Options subcourse. In the last and final section, we'll go over the flavors of options, puts and calls, and then summarize this 3-part series. Thanks a lot.